Hey, everybody. Sam and I just spent two sessions, session 1 and session 2, with a friend and our financial advisor, Rex Emery. And he went over everything with us, from tariffs to recessions to inflation to rates to what you could be doing with your money to long-term health care, over 2 episodes, which we think are going to be really good. Have a listen to Rex Emery on this episode and the next episode of GarageCast. This is a show for anybody that has something that they want to say. It's going to be full of people with a lot of energy, CEOs, OEMs, vendors.
Best practice ideas in this industry and of neighboring industries.
We're talking to people that are on the cutting edge of processes, management.
Serial entrepreneurs, authors. We really have a feast of all different types of senior level people.
A cornucopia, as it were.
A plethora, maybe. Grab a pen, grab a cup of coffee, and have a seat. Start writing. This is GarageCast.
GarageCast. Due to the nature of the content of this podcast, we have to read a disclaimer. Our guest, Rex Emery, is a founding partner of Legacy Wealth Partners, LLC, a registered investment advisor that only conducts business in jurisdictions where it is properly registered or is excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. The firm is not engaged in the practice of law or accounting. Furthermore, the information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. And with that said, Dantzler's head just blew up. Like, if Dantzler was sober, he was confused on the second sentence. Let's be honest with that. But we got a lot to dig into. Welcome to GarageCast. We got a lot of stuff to unpack, not only with Sam, but with our guest Rex Emery. Rex, thanks so much for taking some time.
Absolutely. Thanks for having me. And sorry that you had to go through that mouthful of disclaimers.
Yeah, it's the first time we've ever had to do that, but hey, it should be worth it. But
my takeaway from that was that no matter what I say, I'm not responsible for anything that I say. This
is all bullshit, what I'm about to say. So I don't know, take it with a grain of salt or don't listen. Didn't happen.
Perfect. This is the perfect gig. I got to get that gig. And I'm not responsible for anything I say. That's awesome.
That's awesome. Well, before we get to Rex, let's focus at what's going on. So as we said, last podcast was Schooly. We did a survey and it came back resoundingly that nobody wanted Sam on the podcast. He's actually decided to hijack this podcast. He says, you can't keep me out and down for long. But in all seriousness, dude, let's talk to him about like where you are and what's going on in life.
Well, yeah. I don't know what kind of shenanigans you were pulling last week. I couldn't even follow those segues and, poor grammatical mistakes Schooly was making. I would get him off immediately off of this podcast, but just saying, it's good to be back. I'm sitting over here. If you see me looking to the right or there's banging going on my right-hand side, I'm clearly not in my normal spot. I'm in the kitchen. I have a buggy over here on my right. I have a giant cast on my leg. I had a full right ankle replacement where they dug all the old shit out. AI made me a new ankle specific to me, and they installed it less than 7 days ago. And if you think I'm sober on this podcast, you're mistaken. There's all kinds of chemicals going on through my brain right now. So between Rex's, I can't hold me accountable for anything I said, and whatever shit might come out of my mouth today, I think it's going to be very entertaining at the least, Tony. So I'm going to do my best here to get through this podcast.
This morning when Dantzler and I kind of went over this podcast, I was on the phone with him. I'm like, This is going to be fun because he's operating about 70% of the space between his ears right now. So this could be actually really cool.
It'd be a good time.
And like, hey, what better information than like financial advice and
Right.
tariffs and the economy than to bring this in when you're on all hopped up on Xanny bars and floating. Dude, let's be honest. You're probably just drunk is what it is.
No, there's been no alcohol. But the amount of cocktails that they're giving me, because the pain drugs make you constipated, and then some of those drugs make your stomach liner need drugs, and then one's counteracting the other. And I start talking things. I told my daughter, I'll give you a little example, and then we'll jump into this podcast. Apparently, I've been told that I had a full-on conversation with my daughter the other night that I have no recollection of. And apparently I said, "Hey, Abby, you remember in the movie we were watching last night? You remember when the bad guys were trying to get you, Abby, on the boat? And well, they were trying to close the deal on the boat." And she's like, yeah, Dad. There was no movie. We didn't watch a movie that night. I said, "You always got to go on the boat. All the good stuff is on the boat. So always go on the boat when they're trying to close the deal." And she walked away like, "Okay, Dad." And then I heard that. I'm like, "Abby, never go on the boat when someone's trying to close a deal. Like, stay off of all boats." So
True story.
That's the level of kind of the highs and lows of the last 7 days here over at the Dantzler household.
Nice. Very nice.
Yeah.
Well, glad you got yourself a new ankle. Eager to see how that plays out in the future. For any of you that know, Dantzler has had massive problems with his ankle, and we're talking massive problems for decades. And so this will be exciting to see how this shakes out. So,
Yeah, man. Thank you.
all right. Yeah. Let's jump into this. Rex, you are a friend. We are clients. We have been in business with you before. You're one of the smarter people I know on the face of this earth, and I know you're humble, so you won't agree to that. But why don't you give yourself a quick little intro about what you do and who you are, and we're going to get into the questions right off the get.
Yeah, absolutely. So thanks, Tony. And appreciate that kind introduction. So in general, what I do every day is I'm basically a personal CFO for individuals and businesses. So some people would call me a financial advisor. Some people would call me a wealth manager. At the end of the day, if a dollar sign touches it, I advise on it. So I've done M&A work. I was actually a professor at Denver University in their graduate tax program for 5 years. I have given numerous talks on the economy. I do a lot of retirement planning, business planning, estate planning. You name it. We kind of dive into it. So that's a real high level. But we're located in Colorado, and we do business with people all over the country. So anybody in one of the 50 states, we can help.
Fantastic. Sam and I discussed this about having Rex on, and honestly, here's why we're having him on is there's all kinds of crazy shit going on in this world with the economy, with tariffs, with confidence in the markets and the power sports industry. And so we said, hey man, let's talk to a guy that really knows what he's talking about all this and see if we can't get some color and get some of our listeners informed on some things they may or may not know. So I'm just going to start right off the get-go, Rex, with question number one. And how are trade tensions and rising tariffs affecting the U.S. economy as we speak?
Yeah. So really at the end of the day, it's creating a lot of uncertainty. I know when I'm talking to my business owners that are clients, they're trying to read through like the policies that are constantly changing. I'd say it's a lot like living in a fog. So another thing I think about, Tony, I know you're at least considering learning how to fly planes. It'd be a lot like taking a plane up in the air. Having a bunch of clouds surround you and having no instrumentation. Ultimately, I'd say that's where we are. I'd say the fog's decreasing. We're starting to see that a lot of things have been pure negotiating tactics. And I think one thing I want to kind of put a disclaimer out there, anything that I talk about today, I try to be pretty neutral politically, but certainly some of the topics can be inflaming to individuals. So please no hate mail, anything like that towards Tony and Sam. Just trying to give the facts today. But that's probably the best way to describe it is it's created a lot of fog. One of our clients imports a lot of different goods and components for a product that they create. And they're like, hey, you can't, they're like, hey, we're just going to route some of these products through different countries to avoid tariffs. And the next thing they knew, you couldn't do that. So it's a hurry up and formulate strategy for your business to keep your business alive, to maximize profits, to be able to pay your employees, to be able to provide for your family as a business owner. But fundamentally, it's almost like playing a board game with a 9-year-old. They change the rules. They're like, yeah, but this time, I know it says that in the rule book, but this is what I want to do. And that's a lot of what we're seeing. I know, like, it's been interesting listening to your guys' podcast too, because I've been a long time listener. A lot of times, like on the treadmill or whatever. I was listening to the last podcast where Schooley's talking about zippers and keeping them in the middle in the fire service. But one of the other big things that I heard you guys talking really to, I mean, everybody that listens to your podcast was like the dealer assist sale. And fundamentally, like, why are you talking about a lot of these things? Why are you talking about getting back to the basics? Why are you talking about inspecting what you expect? It's really comes down to controlling that which you can control. There's a lot of that's outside of our control right now when we really look at tensions and trade tariffs, and I mean even things that are happening in LA right now. Like I mean, dealerships might even be affected and going, how do we conduct business during this time? So I think that's the ultimate side of it, is that hopefully over the coming, I don't know, 3 to 6 months, we have more clarity on what the rules are, and then to add on to that, we've got tax policies that might be changing. So it's a interesting time to be advising people, because you're running a lot of different permutations of possibilities, and then kind of sitting down and weighing the pros and cons of different decisions that people could be making. But ultimately, that's really where we are. I know a lot of people are concerned on the trade side of, hey, how are we going to operate? I mean, one of the latest headlines I saw when I got on here is home builders and lumber prices. Like, lumber prices are going all over the place. Client yesterday was saying, hey, he was trying to buy a bunch of steel for a project that he's working on. Of course, I'm sure that's an input to a lot of the goods that your clients sell. And just saying, hey, like, we expected U.S. steel prices to fall. And ultimately, I had to explain to him that it's supply and demand. You decrease the supply from an international source. You have to spool up the supply here domestically. And a lot like what happened during COVID, unfortunately, is you see opportunistic pricing on the input to a product. So again, everybody's dealing with changing rules, but it's a high level on like tariffs and how they're impacting people. But it's a lot like just, again, being in that cloud, flying through it. You don't even have an altimeter in a lot of ways, but you have faith and you believe that there is like the cloud's going to dissipate soon. That's really kind of the sense when we're talking to clients, when we look at news, when we listen to experts that are on the ground in some of these different talks. And so that's a very long-winded answer to your question. So
that's a good one. Yeah.
Well, and I got to believe, I'm no pilot. Tony, you could probably answer this with all the training you've been going through. Like, I got to believe at that point, if you're the pilot in the air, that you're looking at some fundamental dials, just like we used to talk about in the Lemco days with the plane going forward, right? Do I have lift? Do I have fuel? Do I have airspeed? And you just hunker down with those fundamental dials until the clouds break or whatever it happens to be. And I guess, right. Rex, your comment was earlier, you said, hurry up. People are in a state of, they want to hurry up and then they have to slow down because everything keeps changing on them. And my question to you would be, I know you're not, entrenched in the retail space like we are, but what's the advice to your business clients? Do you just focus on the 4 dials that matter to stay alive until the fog clears? Or do you go back to some 101 version of what the business used to look like 10 years ago? Any advice you could offer up to the clients that are out there?
My advice would be creativity. And I think that's what I loved about, like, you guys going back to some of your basics of, like, a dealer assisted sale, for example. Like, before I even heard about that, like, I was like, oh my gosh, I actually am somebody that wants to sell a razor. No, don't reach out to Tony for all my contact information to sell my razor. But that dealer assisted sale, I was like, that is brilliant. So I think honestly, getting some marketing surrounding that, like recently, I've been on a couple of different websites of some of our local dealers and started getting Facebook ads and things of that nature, but none of them talk about that. I think going back to your lists of clients that bought, uh, like made purchases during COVID that are now back to the kids' sports and things, and letting them know that the dealer assisted sale is even a possibility, is brilliant, because you, as a consumer, you list it on one of the different sites you can list it on. And the number one reason why people don't a lot of times go private party is the financing. They can't afford to show up with a wire or some kind of cashier's check or whatever. So, but my advice would be creativity. Like, think outside the box. Think about the vision. And I would encourage, you could even honestly do a almost like a, I don't know, a contest inside your dealership with your employees of, hey, throw a name in a bucket, or an idea in a bucket of how we can generate business. And then everybody kind of votes on it and you go for it. Or say, hey, we're going to try 5 of these things, and the person that generates the most business based upon their idea wins something. You never know what's going to come out of that, and what might bubble up to, like your guys' 20 clubs and things, is a pretty unique idea that nobody had ever thought of.
Like it.
I like that. Let me go from micro to macro. Let's talk about the Fed interest rate. What do you think is going to happen with that? Are we cutting rates soon? Put your magic wizard hat on.
Yeah, so the latest data as of today's recording is that we're going to have less than 2 cuts this year, and they'd probably be in the fall. So if we had talked literally last week, the market was pricing in 2 cuts. Now it's don't ask me to explain how this works, but 1.75 cuts are being priced into the market right now. So fundamentally, I think that consumers, business owners are just like really wanting to see rates come down. And it's just not happening. I have clients that are commercial real estate brokers, some of the biggest in the state, making very large transactions and facilitating those. And one particular person I spoke to, again, number one guy in Colorado, has done 0 transactions this year. Why is that?
Damn.
Interest rates. 0 transactions. This guy, I mean, I've been in business for 25 years. I've known this broker for close to 20 years. Incredibly skilled, specifically in the apartment space. 0 transactions as of a week ago. And it's because interest rates were so low for so long, prices went up a ton. And right now you have a huge disconnect between what a seller wants as a price and what a buyer is willing to offer. We're seeing that in the housing market space too. In my own personal life, don't mind sharing this, but we're probably going to see some development behind my house here soon. There's a big couple of acre lot behind me, and we're thinking condos are going to go on it. So we start going out there and really looking. And it's just amazing the number of people that are having to take price concessions on their homes to get them sold right now. So I think it's everywhere. When you look at interest rates continuing to stay high, I always say if you're trying to borrow money, obviously you want them low. If you're an investor and you're retired, having interest rates where they are is amazing, because it allows you to let's say you have a bond portfolio, for example, or that's probably the perfect example for your podcast. It's basically lending money to various people. That's really what a bond is. So it could be a corporation, could be a municipality. But when rates are high, your income's good. So what's good for one is bad for another. I do also want to stress that the Federal Reserve is like backed into a corner right now, because with what's going on with tariffs, a lot of people are very fearful of inflation creeping up. You may have seen the inflation data that came out today. Inflation has been pretty low. It's not low enough for them to lower rates yet, but it hasn't been spiking. And I'm sure some people are going to go, yeah, but on this podcast, because there's certainly potentially geographical examples of it going up. There might be specific industry examples. But fundamentally, when you look at the calculation of the Fed, which some people would probably say is a sham calculation, inflation's has been pretty muted. So ultimately, when I say the Fed's backed into a corner, it really what it comes down to is the Federal Reserve has two jobs. Can you tell me what those are? Let's start playing the Jeopardy music. Just teasing you guys. So number one is full employment. So keeping people employed. Number two is to keep inflation in check. The issue with inflation, like with inflation, is that you have to raise rates to like basically decrease inflation because you have to slow economic activity. The problem with that is that can cause essentially people to get laid off. So one of the things that we might talk about a little bit later, but I love getting on different economic calls, talking to a lot of different people, some of the best minds in the industry. I won't name drop those people or what companies they're with, but really, really high with big reputable companies. And one of them recently said, probably in the last 12 months, like what could go really, really wrong? And what could go really, really wrong is that you have really slow growth with high inflation. Because ultimately it's really difficult to address both those problems at the same time. So, and we'll probably talk about real estate and stuff a little bit later, but that kind of dovetails into some things I'll talk about on real estate if you guys would like.
Nice. Reading yesterday, the U.S. Growth is now projected at 1.6%. And then I think something like 1.4% in 2026. So it was a total of 3% over the next 2 years. Would that dictate in some way, shape, or form that a recession is looming?
Yeah, I think we're in a fragile place. Historically, I mean, we can go back 30 plus years and GDP growth has averaged right around 2%. You go back to the financial crisis of 2008. And ultimately, what the Federal Reserve wanted to do was get us back on a 2% growth track. You go to COVID era times and the amount of money that Congress authorized and a lot of the quantitative easing and monetary policy that was enacted, that was to get us back to a 2% growth track. So we're in a position right now when you talk about a 1.6 where we're below target as far as what we would consider like a healthy economy, what we'd consider good for so many different metrics of the industry or the globe. So I wouldn't say a recession is looming. If I was to categorically, I guess, staying with this flight analogy, I've got a bunch of different dials I could show you of different aspects of the economy, and of about 16 different dials I could show you that's like interest rates and monetary policy and valuations. And again, a lot of other different metrics. Mm-hmm. We have two that are essentially headwinds right now. And that's geopolitical tensions and stock market valuations. And then you get into the green side of stuff. And this may take you a little bit by surprise because like consumer confidence is pretty low, but the thing that is saving everything is the U.S. consumer doesn't know how to not spend. 70% of our economy is based upon spending. And we spend for comfort, we spend for leisure, we spend for fun, we spend for enhancing our families' lives, at least as we see it at the time of the purchase. That's super resilient right now.
Yeah, super interesting. That fragile balance, right? That everything has to be within a balance. It's like the body at homeostasis or things start to go wrong.
Yeah, exactly.
So how volatile will markets remain after the April crash and rebound?
I think as long as we're in the fog, we're going to continue to have volatility.
Okay.
That's really what I would say. And I don't see us getting out of that fog. Before fall. Like we might have certain aspects that are more clear, but it's almost like whack-a-mole. I don't know if you guys remember going back to the arcade when you were a kid, and there's the big hammer, and you try to hit those things. That's essentially what we're dealing with right now. Is just as one thing, see the fire kind of starts to go out. There's kind of a hot spot that flares up in another area that potentially creates uncertainty. But fundamentally, I think volatility calms down when trade, number one, is clarified. And number two, I would say, is the tax policy side of stuff, so that people understand the rules by which they're going to be able to operate their life, at least in the financial aspect. So I think those two things are creating. There's a lot more that we could go into, but I think those two things help calm things down and decrease volatility as long as something else isn't popping up.
Got it.
So, Rex, let's say just the average investor, dealer, principal, general manager, whatever out there, and I'm going to put you on the spot where you can't say, you can't take anything I say for whatever. Just answer this question. Where do you rebalance? You go towards bonds now? Do you go annuities? You stay invested in equities? Like, where do you move your chess pieces?
Yeah, I'm going to take the it depends answer. It depends on who you are and your priorities. And I'll try to focus it a little bit. If you're somebody that is retired or getting near retirement and you're really wanting to generate income, I have not seen. I got into this industry in 1999. I have not seen since that time period interest rates even close to this high. So what opportunities does that present? Some people that are looking for good income plays, like bonds, actually look pretty attractive. Some municipals, some corporates, and there's a whole lot that goes into that. So devil's in the details there. But if you can lock in good returns for a decent amount of time, that's a good thing. The fixed annuity space, you have to really be careful on what the ratings of the insurance companies are. But like I've seen some 6% rates out there where it's like, hey, for the next 5 years, deposit X number of dollars. And you're guaranteed 6% a year for the next 5 years. So some of those offers are out there. For a retiree, that's like a slam dunk for a lot of them if they don't have big liquidity needs. And some of those products are, I'll just say, not good. So you have to have somebody that will skillfully help you look for the ones that are good. But that's on the retiree side. I mean, somebody that's in their 20s, that's say a mechanic in a dealership, they're just start putting money in, just start saving. I think that some people will tell you that, hey, if you're young, you should be aggressive. I've seen that backfire. I believe that you should meet with somebody, figure out what risk level and volatility levels you feel comfortable at, and then just get really aggressive on saving. I mean, clients that come into our office that are younger, we typically, and people are going to cringe when they hear this number, but if I was to write an article for a local newspaper, it would be, hey, put 20% of your money into investments, like 20% of your income. And that's really what gets you to your goals later. But fundamentally, like probably moderate to aggressive investing makes a lot of sense for younger people. We do a lot of very tactical management here. So we use algorithms, we use AI, not for all of our clients, but we help people to look at different investment strategies. And my belief is that when you're in a time period where you don't really know where you're at and what's going to happen, having some portion of your portfolio that can be active. And what I mean by active is let's just use April as an example. Let's say you were an aggressive investor, but you also are a little sensitive to volatility. Knowing that somebody is doing something in your portfolio as it's falling. So maybe slowing down the speed or the risk level, so to speak, to kind of look around and see what's happening, and to make an informed decision of what you feel like the best decision is at that moment. And I would advise you to not do that based upon emotion. You got to do it based upon facts. But that's the real high level on market volatility, is that we expect it to continue until there's more clarity.
Got it. Good stuff.
Yep.
Is commercial real estate still a risk as the economy slows?
It's a massive risk. Like, I don't want to sound the alarm bells, but I mean, I'm sitting in a huge commercial property as we speak. And what a lot of people don't know about commercial real estate is when you go to the bank to make the purchase, you're generally not taking out a 30-year loan like we all do for a house. You might be taking out like a 10-year loan with like a 5-year amortization. You might be doing all different types of things, but you generally don't see longer than 10-year loans. So as you can imagine, a lot of people 5 years ago, 6 years ago, even 3 years ago, were able to obtain really low interest rates on these commercial properties. And so that drove values up. And now that interest rates are where they are, they're going to have to go to the bank and try to refinance these loans. So the bank has very strict standards by which they approve the loans. So they've got to look at occupancy. Well, we know a lot of commercial real estate occupancies are down. We've got to look at the cash flow and things. So we already have seen a client of ours, and I think this could be the tip of the iceberg, fail to be able to refinance the property. So if you fail to be able to refinance the property, what happens? You either have to find new investors to capitalize the property, so go like to private investors, or you have to list the asset for sale. So list the property for sale. So if enough people fail to pass those tests, then we're in a pretty tough situation in segments of the commercial real estate market. So that's down in the weeds, but that's how it works. So you can just imagine if there's investor pools that don't have the right amount of equity, the income that's being generated from the property isn't supporting the new loan payment, there's a problem, right? So it's we're not out of the woods. The coast is not clear as it relates to commercial real estate, in my opinion.
Damn.
Yeah, Dan was right. Geopolitical conflicts, tariffs, are those a high risk to inflation?
Yeah, they are. And that's just contributing to being in the cloud. They without a doubt, those things can contribute to inflation. And I think that's just hopefully that creates an urgency to create, to really define what the rules are going to be. On tax code, define who our allies are, because sometimes like you'll see headlines like, ooh, that probably made that ally a little bit upset. I think a lot of what we're going through is almost like marriage counseling with the world, but part of the issue with that is that it's almost like going to marriage counseling and there's no counselor in the room. So it's one party, one group's opinion of the way things should be. And they may be right, they may be wrong. But that'll get to another point that I think is important, is that one of the fundamental risks to our country is that we have this growing chasm in society of what people believe is the right way, what people believe is morally correct, what people believe is optimal, if they were creating their own utopia, so it's that's one of our biggest risks, and that ties into geopolitical risks. It ties into civil things going on in our society. The further that gets apart, the harder it's going to be for the country to sustain itself.
Yeah. And definitely palpable these days too. It's definitely been palpable for years. So that's crazy. Good answer. Sad answer. Scary answer.
Terrible answer.
Sorry, guys. You just could just end the podcast right there if you want to, but
yeah,
I would have ended it one question ago.
Yeah.
Yeah.
Hey, Rex, could decelerating global growth impact emerging markets returns? And emerging markets, for those that don't know, Rex, talk to us about those.
Yeah, so emerging markets are just those countries that aren't considered developed markets. So believe it or not, a lot of people still consider China an emerging market. I don't know why that hasn't been reclassified, but ultimately we could dive in and read all the definitions. So with that being said, that just tells you that it's a lot of countries that are much smaller than, say, China. That are considered emerging markets that aren't developed worlds. Like there's a lot of things that go into that, but ultimately it's a lot of countries that you see like in South America, that you see in Africa, that you can see even some of the Asian countries would be considered emerging markets. And this tariff side of stuff is going to be a boon for some of those. I mean, as America looks to decrease their reliance upon China, like a lot of people looked at Taiwan, India. India, I think, is going to come out like a bandit in this thing because
Vietnam.
Vietnam's another big one. So,
Yep.
just some of those different countries. So, I mean, if you have growth slow globally, obviously that's one component. That's kind of your top line revenue. But if it's all of a sudden, it's almost like one company losing a bunch of customers to another company. So for one, it's like catastrophic, can be really, really bad. And for the one that's picking up the new business, it can be phenomenal. Even if the total production or top line is lower than what it was. So if you're an owner of a company that has declining revenue, guess what happens? Likely the ownership interest in the company is worth less. So that's what we're going to be seeing. And that's what the smartest people in Wall Street are trying to figure out is what are these companies worth, whether they're emerging markets or developed markets, based upon what their expected revenues are going to be in the future with interest rates and with buyer, like individuals' credit situations and with, I mean, countries' debt situations. All that stuff is one of the ingredients to coming to a conclusion.
How about U.S. debt and deficit pressures? How can those derail the recovery efforts here?
Yeah, I mean the this one's loaded. So I remember the disclaimer at the front end, but I'm gonna go out on a limb here and just say that neither political party in the United States, so neither Democrats nor Republicans, have been fiscally prudent. When you look at the sustainability of our country. I graduated from college in like 2003. Yes, I started in finance before I graduated from college, for those of you that are keeping track of dates. So our debt to GDP ratio back then, I think, was around 40%. Today, it's 110. Our
Yeah.
GDP has grown. We talked about growth rates earlier at about 2% a year. So that tells you how fast debt has accelerated. And we've seen a ton of growth, like in like people's portfolios and their personal net worths, all that kind of stuff during that time. And what I hate to tell people, it's almost like you want to say this quietly. It's been funded by debt. So when our country goes and spends and borrows, you kind of have to look at what the return on investment has been. The reason why we spent so much is to try to maintain that 2% debt to GDP ratio. I still say the US is the best house in a lousy economic neighborhood. But if you go and you study the fall of societies, and this is not imminent, I don't feel that way in any way, shape, or form. But if we continue on the path we're on, something bad is going to happen. I could sit here and run through those permutations of what could happen. But fundamentally, I think that's where many people who have supported the party that's in power right now are a little disenfranchised right now with the big, beautiful bill. It's big. There are some things that party desires to be in there, but it's projected, experts have said projected to increase our debt up to $12 trillion as it was written like a week ago. Certainly that's subject to change, but that's not in line with all the efforts for Doge and all the things that have riled a lot of people up. So the party or the kind of people in charge that were supposed to try to help fix the trajectory seem to just continue to do more of the same.
Yeah, the couple things that I have studied with all of this is that the interest on our debt is larger than our military budget.
It is.
So there's that. Two, I've watched some presentations with like the Bolios of the world, who Rex, I know who that is. And they're suggesting that somewhere in the 2030, 2033 range, it has to collapse. It can no longer be sustained at the current trajectory, and that we could not necessarily ever find the financial state here to actually pay off the debt. Like, it's not that they're using words like it's impossible. Yeah. It's going to have to collapse, and everything will have to be reset. My question for you both, and I think I read this somewhere, but I'm just, and I can be completely off. I think our budget was balanced. Was it Reagan or Clinton where we were good? I mean, it's been in our lifetime where we did not have debt, right? So do you guys remember that?
But we've always had debt, but at least it wasn't increasing. So that's what a balanced budget is.
Yeah.
But Sam, you were going to say something.
No, I thought it was Reagan.
Could be.
You know, I recently, it's a movie, but I did research Reagan back in the day, and I watched that movie on Reagan that came out recently, and they highlighted that some of his greatest accomplishments. And you have to look back into the Reagan era, as they say it, to find a balanced budget. So it's been in our lifetime. Yeah.
Yeah, it has been in our lifetime. So it can be done. So the problem is we have career politicians that are afraid to make tough decisions, and because it could cost them their career, so that's what we're dealing with. But this is no different than starting a diet. Like, hey, if you need to lose 40 pounds, like, there's a process. If your family has a ton of debt, there's a process. And that process is not without pain. And the problem is we're all fighting about, we need to lose. A lot of people agree we need to lose weight, but it's like, hey, do we want to be keto or paleo or low carb or Atkins or whatever? We can't decide what macronutrient, so to speak, to cut, or what input to cut to get to the goal, because some people really like sweets and other people really like steak and other people love salads, you know? So, I mean,
Rex, I appreciate that you have dumbed this down for Tony's benefit. Thank you very much. He appreciates it for you.
Yeah. So it's just all true. And so when you look at the different budgets, like I'm looking at it over on my screen here, I mean, our deficit is about 27%. So, just to look at it simply, I mean, if you make $100,000, it means that you're spending basically $127,000 a year, therefore borrowing the 27. You can't do that. And some people say you can, because you can just print money, you know, but it just doesn't end well historically. And I think that's why so many people are looking at different ways of solving this. And I think it's creating different industries that are out there today. Crypto industry is one of them. I mean, it's really, really sad that we wait till the last minute to solve most problems in society right now. We wait till it's crisis mode to make a decision. And then it's usually partisan votes. I believe, I'm going to just put this out to the world. Maybe it'll go somewhere with one of your listeners, but I believe it should be a requirement once you're elected to pass micro and macroeconomics. I'm not just saying pass it. I'm not saying get an A. Go take the darn class at a community college and pass it, because I think a lot of decisions that are made A lot of politicians don't understand the ramifications of the decisions. They just want to help. And sometimes helping is hurting.
Yeah, I can see that. That's a smart call. What are the biggest unseen risks, tariffs, energy shocks, or AI regulation?
Yeah. Kind of looking at the AI side of stuff, I mean, AI regulation is really the thing that could pop the bubble, because there's so much investment going into that space. I mean,
Right.
today, like, I mean, I'll show it to you guys because you can see me, but, and this is not an endorsement of this company, but Plaid, it's PLAUD. It's on my phone. It looks like a credit card. This is AI. I use this, I'm not using it right now, to transcribe my meetings, any conversations I'm having, to summarize a team meeting. I've got roughly, we're approaching 20 people on our team here at Legacy Wealth Partners. And sometimes we need to disseminate a summary of a meeting. So that's an example of things that are just like revolutionary. So I do think AI is definitely a cool place to invest, but the big question is what's done with all that data and who's it sold to. We saw the 23andMe comments of like one of the real high people in the state of California regarding that company. And I'm a user of that company. I think it's pretty cool. I did not close my account, but there was a call to do those things because of data security. So data security, regulation, those are big topics in that space that could really cause the bubble to pop, so to speak. I mean, Elon Musk, geez, I said that name on your podcast, but he is just so inflammatory. But I think most people would agree, like, that there's some level of intelligence there and problem solving. And he, for years, sounded the alarm on just AI and how bad it could be. My wife tells me on a regular basis I'm getting too close to the robots. And she's like, have you not watched all the different movies regarding the robots and how it ends? So I think that's where a lot of people have fear when they hear the term AI. So that's a real high level answer to your question, but that's my concern in that space is valuations are just so high. And for those of you that aren't familiar with valuations, we look at like price to earnings ratios on stocks. It's a price divided by earnings. And valuations are just high right now in those spaces, but people believe it's okay because of the future growth. Again, regulation could completely change that trajectory.
Crazy.
It's crazy.
Yeah. Well, everybody, we're gonna pause right there, man. We're gonna make that episode 1 of 2. Rex, I can't thank you enough for joining us. Come back next week, guys. We're gonna have episode 2 of 2. For Rex Emery and Sam Dantzler, I'm Tony Gonzalez. This has been GarageCast. Have a fantastic Tuesday, everyone.
Thanks, everyone.
Yeah, thanks.